Every time you place a stop loss, you're telling the market exactly where you'll panic. And somewhere, someone is reading that information and trading against it. There's a pattern that veteran traders call stop hunting. Prices drop just far enough to trigger a wave of stop losses, then immediately reverse. It happens too consistently to be coincidence. By the end of this video, you'll understand exactly who's doing it, how, and what you can do about it. First, let's talk about market makers. A market maker is a firm, think Citadel Securities, Virtue Financial, Jane Street, whose job is to be on the other side of your trade. You want to buy a stock? They sell it to you. You want to sell? They buy it. They profit from the spread, the tiny gap between the bid price and the ask price, multiplied across millions of trades per day. But here's what most retail traders don't realize. Market makers can see your orders before they execute. When you place a stop loss at your broker, that order sits in a queue. Many brokers, particularly those offering commission-free trading, sell that order information to market makers through a practice called payment for order flow. The market maker sees where your stop is. They know your exit price before you've hit it. Now here's where it gets interesting. Market makers aren't just passively reading your stops. In certain conditions, they have a direct financial incentive to push price toward them, and it doesn't take much. Here's how the mechanics work. Imagine a stock trading at $50. Thousands of retail traders have placed stop losses clustered just below a round number, say $48. That cluster is visible in aggregate to participants with access to order book data. A market maker or a large institutional player can short a relatively small amount of stock to nudge the price down toward $48. When it hits, the stop losses trigger automatically. Those stops convert into market sell orders, a sudden flood of selling pressure. Price drops sharply, the market maker covers their short position into that selling, pocketing the difference. Then, with the stops cleared and no more sell pressure, price bounces back. The whole sequence can play out in seconds. This isn't illegal in the way most people assume. Market makers are providing liquidity. They're not guaranteed to know exactly where every stop is, but the informational asymmetry, enabled partly by payment for order flow, creates conditions where sophisticated players can anticipate retail behavior with uncomfortable accuracy. So if you can't trust a tight stop loss to protect you and might actually be handing a roadmap to the people trading against you, what do you do? A few things change once you understand this. 1. Avoid placing stops at obvious levels. Round numbers, recent swing lows, and support lines that every chart reader can see are exactly where stop clusters form. If your stop is obvious, it's a target. 2. Consider using mental stops instead of hard stops for liquid, heavily traded names, especially around high volatility events like earnings or Fed announcements, when manufactured moves are cheaper to execute. 3. If you must use hard stops, place them at non-obvious prices, not $48. Maybe $47.63. It won't make you invisible, but it puts you outside the densest cluster. 4. Understand your broker's order routing. If they use payment for order flow, your stop order is more exposed than you think. Here's the honest truth. Markets aren't rigged in the Hollywood sense, but they are asymmetric. The people with the fastest data, the deepest order books, and the clearest view of retail behavior will always have an edge. Your stop loss, the thing you place to protect yourself, can become the mechanism they use against you. Knowing that doesn't mean stop losses are useless. It means placing them thoughtlessly is. Next time, we're going even deeper into the market structure rabbit hole, into the 40% of stock trades that never touch a public exchange at all, and what happens in the dark.